Hi, good morning everybody. I'm going to give a presentation about global capital flows and essentially how global capital flows are having an impact on Europe. So who's buying, what they're buying, where's the money going, why is it going into certain sectors or assets than others, and how are we going to proceed as we hit the end of the cycle, both investment, economically, and in terms of what appears to be cooling in occupier market cycles. So if we look at global flows, we're seeing a continuation of the trend that we saw in 2017, where we saw increasing levels of capital into Asia, which is the grey bar. What we've also, and that is predicted to continue to grow towards the end of this year. These aren't real numbers; these are predictions based on investment year to date. Also bearing in mind how much typically transacts in the second half of each year. So basically, Asian capital is growing. It's flat in the Americas, but it's starting to decline or tail off in Europe. We're around about 10% down. When we look at yields, yields are relative to each other. Asia Pac is lowest, then we've got Americas, then we've got EMEA, and then we've got the Americas, but they're all starting to flatten off, which is also quite interesting. So is that the start of maybe a slight uptick for some markets, particularly the Americas, which has got higher interest rate rises? If you look at Europe in more detail, as we can see, the light blue bar represents investment in the first half of the year, and we can see that is down 10%. When we look at where the capital is coming from, we've seen a bit of an evolution in terms of how much domestic capital has been involved in the market relative to cross-border, but we're now at parity. So there's 50% of the money that's coming in this year is domestic, 50% cross-border, but we are seeing differences in terms of the cross-border global capital coming into the market. And we can see that here. So the dark blue bar represents money coming in from the Americas, essentially North America, US and Canada. The middle part is APAC, the top part is Middle East and Africa. So we can see the Middle Eastern, the sovereign wealth type funds have started to diminish. The market share of APAC has actually grown quite significantly in the last few years, and we can see that represented as a percentage by the yellow line. North American capital, interestingly, despite being the dominant force of capital globally, is starting to decline in terms of its share in European investment. And APAC in particular has gone from about 15% to about 30% across border, which is about 15% of investment per se into Europe. That's a tripling of that in the last few years, which is significant. But interestingly, again, when we look at the source of that Asian capital, we again see some big differences. So the very light blue bar, part of the chart at the top, is the Australians, or in the Kiwis. So we can see at the end of the last cycle, very heavily dominating Asian capital coming into Europe. At the minute, we're starting to see only early signs of maybe they are starting to come back in, and certainly there's more noises about what they're doing and what they're planning on doing. So they could be coming back into the market. Not an awful lot coming in from South Central Asia, only a very marginal amount, which is India, Pakistan, some of the other stands. The big chunk is clearly East Asia, which is China, Japan, South Korea. So over time it's been China, more recently it's South Korea, and increasingly we're seeing much more Japanese capital setting up to start investing in the market, and that's a big push from them. In the middle you've got your Southeast Asian capital, which is your Singaporeans, your Malaysian, your Indonesian money, which again is taking a big chunk, but the big chunk of money is coming from Japan and South Korea at the minute. What they're buying, essentially if we look at the two pie charts on the right, the top shows where the money has been going by sector in 2007, so heavily dominated by offices and retail, but in industrial, not so much in apartments, hotels or development. 2017 to date, so the last 18 months, the big thing here is the continuation of the residential sector, which has gone from 6% to 16%. So there's clearly a lot more money going into the residential market, less in offices, less in retail. Industrial has also grown by a few percent. Hotel flat. Development is actually down relative to 10 years ago, and as we'll see a bit later, I think there's definitely demand for more development in the markets. Now if we look at residential specifically, we see some interesting things. So firstly, the concentration of where the money is going. So it's very much dominated by Germany, the Nordics and the UK, Benelux. Some of the other Germanic markets, it's not really spreading any further, such as Spain or France or into Central and Eastern Europe. which suggests that there is an opportunity in those markets to develop residential or to provide PRS. And then if we fragment residential itself, into student housing or senior living, again, we're not seeing that big a number. So there's a lot of talk, there's a lot of press, and there's a lot of chatter around it. We're not seeing that much in terms of the quantum of deals happening within those kind of individual niches of resi. And again, with student housing, it's hugely, the distribution is hugely dominated by the UK, which is definitely the most mature market. It's been going for about 20 years now. Can we see it expand into other continental European markets where the makeup of markets is different, but again, there could be an opportunity. Obviously, with declining working populations and less younger people coming into the workforce or coming into Europe per se, that's a finite level of demand, whereas the expanding level of demand is in senior living, even less investment than in student housing at the minute, a bit more distributed by geography. But to what extent can investors, developers start tapping into that senior living segment? I mean, how big could it be when you've got 20,000 people hitting retirement age in Europe every day? That's a pretty big number. Now, the other part of residential is PRS. Obviously, you've got mainstream PRS, long-term rent. But it's interesting to see just how big an impact Airbnb is having across Europe. If you look at the distribution of growth in demand, this is not the supply of accommodation, but we're looking at big growth figures year on year, up 70% in Edinburgh and Madrid, and the lowest figure is 14%, which is still a pretty strong growth rate. Dublin up almost 50%, London up almost 50%. So there's a lot of growth in demand for Airbnb accommodation, and it's distributed across all European cities, into Budapest, into Prague, into Southern Europe. So that is definitely an interesting growth story. And then when you look at it relative to total overnight stays, its share of the entire market, which includes how many people are booking into hotels, is also expanding quite significantly. So it's up to 20% now in Edinburgh, and Budapest and Copenhagen. Some smaller numbers in Stockholm, Frankfurt and Manchester, but it's still having an impact. But the big impact is on the resi part, not just the hotels part. It's definitely a complementary or supplementary form of hospitality and accommodation in cities that otherwise don't provide it. So it suggests there is an opportunity within that sector itself, whether through Airbnb or not. For some owners of Airbnb, there's also a suggestion that it's definitely professionalizing. So there are more and more multi-listers with 3 or more units using Airbnb, and they're starting to dominate in some markets how markets operate. So it is professionalizing, and it's just interesting that it's expanding so much. And despite cities doing their best to regulate it, and it should be regulated to create a fair playing field, it's like Tom and Jerry. Jerry's the market. You never really quite catch it. You've just got to try and allow it to happen in the best way that it can, and it's definitely a good thing for city economies, so it appears. So that's one disruptor. The other big disruptor, of course, is co-flex working. We've seen that talked about a lot in the last couple of years. It's definitely a big factor and a big feature of office markets. We look at the scale of London, the number of operations in this city compared to the rest of Europe. It's just vastly, significantly bigger. And London itself is in a much kind of further evolution of its co-flex working operation. So it's gone into consolidation phase after establishing and growing quite rapidly, whereas a lot of other markets are in a rapid scaling up phase. So the German 7, Paris, Dublin, some of the Nordic markets, Amsterdam. And what we're seeing in terms of take-up or the impact on take-up from co-flex working is, in Amsterdam it's now about 10% of the take-up in the market. The German markets, it's gone from 5 to 7.5%. It will undoubtedly grow again next year. I think WeWork's the biggest occupier in London, and I think something like close to 78% of deals signed in 2018 in London have been for units of less than 5,000 square feet. It was only about, I think, 69% a few years ago. So it is growing. It's definitely changing the office market. Less leases, need for more flexibility, and there's also a need to appease more talent and the changing nature of our workforce. What's also interesting is premiums from flex co-working operations to traditional prime rents. So for a lot of existing landlords, certainly in London, they're starting to take flex co-working on board and putting it into their schemes and into their portfolios. There's a financial advantage to that in terms of the premiums you can get, but obviously there's a cost to servicing those types of flex operations in terms of managing in capex. To what extent these premiums are going to be sustainable over time is definitely a question, but for now they are trading at a premium, and it's clearly of interest to people or investors, owners to tap into that. Okay, talent. Two things with talent really. We've seen a lot of employment growth over the last 3-4 years, but interestingly in the last year and a half, if the chart on the left, so blue represents employment growth, employment intentions of employers, corporates to expand their workforce is actually declining. Now a lot of that for me is to do with just declining rates of labour market capacity and availability. We've got very low unemployment rates across a number of cities. They continue to shrink, and certainly with a lot of occupiers that we work with, they're finding it more and more challenging as to how to run their operation or set up an operation, or trying to find new pockets of labour availability across kind of the last remaining parts of Europe when it comes to the production industrial side. So it's definitely a big challenge, and it's having an impact on economies amongst other things. So we can see for 2018 economic GDP growth is down. Forecast for next year is across pretty much all markets further cooling. Obviously it's not just about employment capacity, but it is a big part of it, and a big challenge for European economies is how they become much more productive, adopt and embed much better AI, software, hardware, robotics into their operations to drive productivity and help drive wage growth, which is going to be better for the economies per se. So that's definitely a big challenge for the next mid to long term, let alone the next couple of years. Back to offices, the current position is quite strong for a lot of office markets. Essentially the vertical axis shows annual absorption rates by market relative to overall availability. The yellow line across the middle is the average for Europe. So that 24% means that it'll take 4 years for take-up to absorb the remaining amount of available space. Now 3 years is quite healthy, and that suggests that anything above that line needs a bit more development, or may need some redevelopment. And certainly you've got to be redeveloping relative to the flexible office space that is needed. It's vacancy on the right. But basically, any markets that are in that top left part are probably the stronger development markets, or the markets that are going to support rental growth or rental stability in the years ahead. Those going the other way, less so. And if we look at conditions in office markets, we can see that at present most markets are very much landlord friendly, rather than being neutral, which is the ones in the blue, or tenant in the yellow. We have a mixture. But overall, the consensus is towards, a growing consensus has been towards landlord-friendly markets. But going out the next 12 months, we do actually expect that to cool off, more neutral markets to appear and take over from some of the landlord-friendly markets, as we see this cooling in occupier growth and economic growth, despite the very strong supply-demand fundamentals. Industrial is similar, but a little bit different. Again, the macro growth side is tapering off a little bit, the yellow line and the blue lines in terms of production. When we look across the markets, again, there's a strong belt of landlord-friendly markets. There's quite a lot of neutral markets, including a lot of markets in Poland, which there are specific reasons for that particularly. Far less tenant-friendly markets. So overall, even more landlord-dominant markets, and we actually expect that to increase even further in the year ahead. So there's structural reasons for that, rather than the cyclical economic reasons, and that's all to do with e-retailing, e-commerce. It's also another very tightly constrained market. Vacancy is around 5% across the board. Some markets are at 1%, 2%, if not lower. And we still see that continual structural shift, but it's not going to go on forever. And if you look at the change in growth in sales for e-retail driven companies relative to traditional bricks and mortar companies, they're starting to converge. So the growth rates are still there, but growth rates are slowing for e-retailing. They're growing for bricks and mortar. So that essentially points to the fact that logistics can't just survive on its own. It's there to support retail, and retail is starting to make a comeback. And for e-retailing companies, we're seeing growth into what we call showrooming in major cities, because they have to sell and advertise their wares within centres. You can't just run it off logistics, and your profit margins tend to be much lower for e-retailing companies than they are for retailers that operate either just through bricks and mortar or in proper omni-channel operations. So retail, we're not really touching on it so much now, but I think it will make a comeback, and it's probably much better than it has appeared to be for the last 2 years. So the last part is where to invest, rather, in terms of what sectors. We've done this cities of influence work for the last couple of years now, where we've looked at 50 different markets and what's their occupier strength and their strength in terms of attracting and retaining talent. And we compare that with investment volumes, which runs along the horizontal axis. Now, London and Paris, they're way out in front of any other market as super metros. And then you get a lot of other cities that follow closely behind, but are really quite closely grouped together. But what's interesting is if you glue some of those cities together into the functional regions in which they operate in and which they're being marketed by, and it does seem to show that for some of them, the sum or the whole is greater than the sum of the parts, if that makes sense. They can now compete more closely in terms of their attractiveness to the likes of Paris and London, Madrid, Berlin. And when you see them relative to their individual parts, they clearly perform much better as a collective. And as a lot of investors are now looking at regions and urbanization, a lot of these yellow kind of super regions are very urbanized centers. And that is clearly the way that occupiers will start moving, investment should start moving. But again, when you look at different cities that could make up a region, you can really blend your portfolio relative to the returns that you get from different cities by different asset classes. That's the other advantage to it. But I think what's also interesting is over the last 5 years, everybody would have made decent money, depending which market you were in. Over the last year, we're starting to see some differences and a few negatives cropping up, which definitely suggests that we're moving into the end of cycle, and you've got to be careful what you're buying and where you're buying it. To summarize, we're moving into a different part of the investment cycle, different types of assets, different drivers of what's going to make assets work or not. There's still the very traditional churn of funds that are coming back to market, and that will add some quantum to what can be bought. But diminishing talent pools, cooling economies is going to hit traditional sectors. It's not going to eradicate them by any way. It just means they're going to be functioning differently. So the type of real estate they need is going to have to function differently or be built differently. Certainly for offices and industrial. I think industrial retail definitely balancing out, and retail should make a comeback. Resi-driven opportunities seem to be by far the greatest because of the demographics and just the lack of investment into them up until this point. And also, we definitely need more development or redevelopment and debt to support it. And then again, going forward, I think it's about super metros and regions rather than just picking specific cities or sectors within those cities. And that's it for this morning. Thanks for listening.